Hi traders, in this new video we are going to take a look at trade management in a different light. We are gonna take a look at the most common tips and find out if they are worth following or not. If you are new here, we at FTMO are funding successful traders, so if you are a profitable trader but you miss trading capital, go to ftmo.com where you can find out more. The first advice you can commonly find online is to put your stop loss to break even once you are in profit. A free trade is the term that most traders use as the fact that they are in a position which is well in profit and it is a risk-free trade. Is this the right mindset to have? If we are going to take a look at this trading example on Euro USD, we can assume that we opened a long position after the break and retest of the resistance area. As you can see, price very quickly moved our direction and we are sitting well in profit. For this trade, we are targeting a 3-to-1 risk-reward ratio, and after price spikes up, we are sitting around 2-to-1 in profit. What a lot of traders do in this situation is to put their stop loss to break even and simply wait for the price to either hit their profit target or to go to break-even stop loss. If you put a risk of $100 on this trade and you are currently sitting in $200 profit, if now this trade goes all the way against you and stops you out, you technically lost the $200 you had in open position. So was this really a risk-free trade? I don't think so. As a lot of traders use technical analysis, moving a stop loss to break even, which is quite often at a random price, it is the least technical thing that you can do. And as you can notice on this Euro USD trade, price would retrace all the way down, hit your break-even stop loss and push to the original target. So how can you deal with this? Instead of going to break even, move your stop loss according to your technical strategy, or you can even add some filters to your strategy, which will make your exit of the trade. As you can see, something very simple such as adding a 9 exponential moving average and getting out of the trade once price closes below it would in this case give us around 1.5 to 1 risk-reward ratio. Does price sometimes fake you out and you exit just to see price hitting the original target? Yes, but securing some profits is much better than seeing trade which was profitable go against you and hit the break-even stop loss. With break-even stop losses comes a second popular tip which traders often follow, and it is scaling out of the trade. This boils down to the fact that scaling out of a winning trade, also known as securing some profits, is much more psychologically acceptable than holding a trade to the one predetermined target. Although this can be true, once we are going to take this simple example, you are going to see how unfavorable to your long-term success scaling out from your trades actually is. In this scenario, we are starting with $10,000. Let's say that you have a strategy with a strict 3-to-1 risk-reward ratio and a risk of $150 per trade. Over 10 trades, you are going to have a 40% win rate. In the first table, we can notice that with the all-in, all-out approach, you will end up with $900 as your 4 winning trades give you $1,800 profit and your losers cost you $900. So what about the scenario where you close 1/3 of your position every time you increase your risk-reward ratio by 1? So you will close $50 after 1-to-1 risk-reward ratio, another $50 after 2-to-1 risk-reward ratio, and the final third at 3-to-1 risk-reward ratio. While your losses remain the same, you can see that your winners are actually only $300 instead of $450 per single trade. After 10 trades, this will only give you profit of $300 instead of $900. If you want to scale out of your winners, you have to learn to scale out from your losers as well, something which is all of a sudden not so comfortable to do. Our trading psychologist Celeste talked in her videos how to build confidence in your trading, and this is 100% something you should work on. Being confident in your trading system and running a calculation on your expectancy is a must for every long-term success. The last topic of discussion on the common trade management tips is adjusting position size depending on your performance. In other words, conventional wisdom quite often says that you should size up if you are on a winning streak and size down if you are on a losing streak. Same with the previous example, we can use a simple example of 10 trades in a row. With the previous example, we looked at risk-reward ratio and scaling out of trades. Now we are going to look at things in a little different way. Let's keep our risk of $150, which is the 1.5% on a $10,000 account. As with the same table, you started trading and hit the 6 consecutive losses in a row. After the 4th loss, you felt like it was enough and you cut your risk to half, risking only $75 or 0.75%. You get another 2 losses, but then you come to a winning streak of 3 winners in a row. But because you are only risking half of your usual size, you end up winning $225 on each trade. After the 3rd win, you risk your full size again and get a full win. If we are going to compare this to the same trading sequence without reducing your risk, you can notice how, as with the previous example, your risk changes drastically. This is simply because you never know when you are going to hit a winning or a losing streak in the market. There is always a certain amount of randomness in the market, and you never know when you hit a rough patch. We at FTMO know this, and that's exactly why we are going to give you a new FTMO challenge for free if you are not able to hit your profit target while maintaining at least some profit and do not violate any rules. Alright traders, we hope that you like this video and we hope that we shed some new light on things you might not be aware of. As always, do not forget to subscribe to our YouTube channel, and if you liked this video, let us know in the comments what you would like to see get covered next. And of course, don't forget to trade safe.